$74 billion. That is how much value vanished when one of the most admired companies in America collapsed. Employees lost their jobs, investors lost their savings, retirement accounts were wiped out, and a company that had once been celebrated as the future of business became a symbol of corporate deception. But Enron did not collapse because of a natural disaster. It did not collapse because customers suddenly disappeared. And it did not collapse because the economy turned against it. For years, Enron appeared to be one of the greatest success stories in corporate America. The company was praised by analysts, admired by investors, celebrated by the media. In fact, at one point, Enron was repeatedly named one of America's most innovative companies. From the outside, everything looked extraordinary. And that was exactly the problem. Because while the public was watching success, a very different reality was developing behind the scenes. This is the story of Enron, and how one of the most respected companies in the world became one of the largest corporate scandals in history. To understand what happened, you first have to understand the image Enron created. Founded in 1985, Enron began as an energy company. At its core, it bought and sold natural gas and managed energy infrastructure. There was nothing particularly glamorous about that business. But during the 1990s, Enron started presenting itself as something much bigger. Its executives claimed they were transforming the energy industry. They talked about innovation, technology, and the future. Investors loved the story, Wall Street loved the story, and perhaps most importantly, the media loved the story. Enron wasn't just selling energy anymore, it was selling a vision, and people were eager to buy into it. As confidence grew, so did the company's stock price. Year after year, investors watched the value of their shares rise. The company expanded into new markets. Executives appeared on television. Business magazines celebrated Enron's leadership. Everything seemed to point in one direction: up. But beneath that success, something unusual was happening. Because while Enron was becoming richer on paper, many of its business ventures were struggling in reality. Some projects weren't generating the profits investors expected. Some investments were failing. And some decisions were creating enormous financial risks. Normally, a company facing those problems would report weaker results. Its stock price might fall. Investors might become concerned. Questions would be asked. But Enron found another solution. Instead of allowing reality to damage its image, it began finding ways to hide reality. One of the methods involved complicated accounting practices that made the company's financial health appear stronger than it actually was. Losses could be moved out of sight, debt could be shifted elsewhere, poor performing assets could become harder to see. To the average investor, everything still looked healthy. The reports appeared impressive, the numbers appeared strong, and confidence continued growing. Now, it's important to understand something. Most investors do not personally inspect every financial detail of a large corporation. They rely on information provided by management, accountants, analysts, and auditors. Trust is built into the system, and for years, Enron benefited from that trust. As long as the company continued delivering a convincing story, relatively few people questioned what was happening underneath. The stock price kept rising, the praise kept coming, the reputation kept growing, and success itself became evidence that success was real. But that creates a dangerous cycle, because once people become convinced that a company is exceptional, they often begin interpreting every piece of information through that belief. Good news confirms the story, warning signs get ignored, doubts are dismissed, and skepticism becomes increasingly uncomfortable. At Enron, that process played out on a massive scale. Analysts praised the company. Investors rushed to buy shares. Employees invested their retirement savings. Everyone seemed to believe they were participating in something extraordinary. But hidden problems do not disappear simply because nobody wants to look at them. Eventually, reality demands attention. And by the early 2000s, cracks were beginning to appear. Questions started emerging about Enron's financial statements. Some observers struggled to understand exactly how the company was making money. Others became concerned about the complexity of its accounting practices. The numbers looked impressive, but the path leading to those numbers was becoming increasingly difficult to explain. And when financial reports become harder to understand, that should often be treated as a warning sign rather than a sign of brilliance. The scrutiny intensified, investigations followed, confidence began to weaken, and suddenly, the company that had seemed unstoppable was facing a problem it could not easily solve. People were starting to ask questions. The more investigators looked, the more troubling the picture became. What had appeared to be strong financial performance was, in many cases, supported by accounting structures designed to hide risk and debt. The image investors had trusted for years was beginning to unravel, and confidence, once lost, can disappear very quickly. As doubts spread, investors began selling shares. The stock price started falling. Then it collapsed. Billions of dollars in value disappeared. Employees who had spent years building careers at Enron watched their futures evaporate. Many had invested heavily in company stock. Some lost retirement savings they had spent decades building. Investors suffered enormous losses. The company spiraled into bankruptcy, and one of the most celebrated corporations in America became one of its greatest failures. The collapse shocked the business world, not only because of its size, but because of what it revealed. For years, people had assumed that reputation meant reliability. They assumed that innovation meant competence, they assumed that growth meant strength, and they assumed that success meant the underlying business was healthy. Enron challenged all of those assumptions because the company had become extraordinarily successful at managing perception. But perception and reality are not the same thing. A company can have a strong reputation while hiding serious weaknesses. A stock can rise while risks are growing underneath, and a business can appear healthy right up until the moment it isn't. That is one of the most important lessons from the Enron story. The greatest risks are not always visible. Sometimes they are hidden behind confidence, hidden behind complexity, hidden behind success, and hidden behind a story people desperately want to believe. Years later, Enron remains one of the most studied corporate collapses in history, not because it was the first business to fail, and not because it was the largest, but because it exposed something deeper about human behavior. People often trust confidence more than evidence. They trust reputation more than verification. And when enough people believe the same story, questioning that story becomes increasingly difficult. But reality does not care what people believe. Eventually, the truth arrives. And when it does, perception can collapse much faster than it was built. Enron's story is not just about accounting. It is not just about corporate fraud. And it is not just about a failed company. It is about what happens when image becomes more important than substance. Because in business, The most dangerous companies are not always the ones that look weak. They are often the ones that look unstoppable. And sometimes, the closer a company appears to perfection, the more carefully investors should look beneath the surface. If you enjoyed this investigation, subscribe to Forensic Finance with Whitmore. Next week, we'll uncover another corporate collapse and the lessons hidden behind the headlines. See you then.